folks. This is Scott Nelson from SLN Financial with our October 2014 Educational Economic Update. In this month's video, we'll be discussing a couple of the economic events that occurred last month and give you some insight into what they mean for you as an investor. Please stay tuned at the end for a required disclosure statement. First of all, I want to acknowledge that volatility and market declines are very stressful. It's hard to keep calm when you see your account value go up and down. However, it's important to keep in mind that market corrections are a natural and normal part of overall market cycles. Since 1928, the S&P has generally experienced between 3 and 4 corrections of more than 5% each year. This most recent pullback was the 20th decline of 5% or more since the bull market began in 2009. Many analysts predicted a pullback this fall. Between the beginning of 2013 and September 19, 2014, the S&P 500 gained 43.35%. The recent market decline was largely caused by fears surrounding recessionary pressures in Europe, slowing growth in China, Ebola, and some negative domestic economic reports. However, the good news is that economic fundamentals remain strong and the sell-off is mostly fear-based. Though the S&P 500 lost significant ground, it's still up over 8% over the last 12 months. Looking further back, the S&P 500 is up nearly 75.5% since October 2009. How far stocks decline during a sell-off depends on a lot of factors, including investor sentiment, corporate earnings, and future growth prospects. In this case, markets are largely moving because of fear, not because of fundamental factors, so we can hope that the sell-off will be brief. Although global worries still exist, equities halted their slide and regained ground on the strength of positive earning reports. This willingness to respond to good news gives us hope that investors will soon move back to optimism and buy the dip. Though market sell-offs are almost never welcomed, I want you to remember that they are a natural part of market cycles, and it's important to take them in stride. As professional investors, we've learned to seek out the opportunities in market volatility and corrections. While we don't engage in short-term speculation, we do use sell-offs to find tactical investment opportunities. Market declines also give you the opportunity to really test your risk tolerance and make sure that your financial strategies are aligned with your long-term goals and attitudes about risk. It's very important to stay calm and not panic. While we can't use the past to predict the future, history shows us that staying calm and patiently waiting out the brief rough patches often benefits us in the long run. October was a jittery month for financial markets, though the U.S. economy continues to do quite well. Despite slowing growth in Europe and Asia, most signs point to accelerating economic growth in the United States. Let's take a look at what happened last month. Investors got their first look at third quarter economic growth and found that gross domestic product grew a whopping 3.5% for the 3-month period ending in September, beating economists' expectations by a wide margin. Though GDP growth decelerated from its 4.6% pace in the second quarter, it was the fourth quarter out of the last 5 that the economy has grown more than 3.5%. Let's keep in mind that this is only the first GDP growth estimate, and it will definitely see revisions. Higher or lower we can't know until more reports come in. However, at least one major player felt good enough about economic growth to make some major policy changes. The Federal Reserve announced the end of its groundbreaking quantitative easing programs, meaning that after October, the Fed will no longer purchase new bonds to support the economy. This means that the Fed feels good enough about the economy to take off the training wheels. They will, however, hang on to their $4.5 trillion in bonds for a while longer, in case the economy needs a bit more help. Digging a little deeper into the news, analysts are reading a bit of a hawkish tone to the Fed's announcements, which means that there's a risk that interest rates will rise sooner rather than later. Because the Fed feels optimistic about the country's economic outlook, some analysts think that rate hikes might come as early as spring 2015. Either way, we're confident that the Fed will look closely at all the data available before making any big decisions. Consumers are also feeling great about their economic prospects. Consumer confidence surged in October to the highest level we've seen since October 2007. Overall, Americans are feeling much better about their job prospects and their ability to qualify for better jobs and raises. This is great news for consumer spending and the economy going into the holiday shopping season. Third quarter earnings season kicked off in October, and now that more than half of S&P 500 companies have reported in, we have a pretty good idea of how companies did last quarter. Overall, earnings are quite decent, but reports indicate that U.S. companies continue to do basically well. For the 287 companies that we know about, total earnings are up 6.5% from the same period last year. Even better, revenue is up 5.1% as compared to a four-quarter average of 3.5%. This means that demand is coming back and U.S. firms can hopefully look forward to a better revenue picture in the coming months. Looking ahead, investors will be looking carefully at earnings data and growth prospects for the rest of the year. Although third quarter earnings are looking decent, analysts are now looking forward at guidance about fourth quarter earnings. Though the domestic growth picture is looking rosy, many firms are worrying about how slow global growth will affect their sales. With the recent strength of the U.S. dollar against foreign currencies, it's possible that exports will fall as they become more expensive to foreign buyers. I hope you found this video to be educational and reassuring. If you have any questions about how you're invested or how recent market movements may have affected your portfolio, please give us a call at the number below. We're always happy to help. As always, we'll keep you informed. That's it for the October Educational Economic Update. Once again, this is Scott Nelson with SLN Financial signing off for the month of October 2014. If you have any questions about what you've heard in this update or would like to discuss your personal financial situation, please give us a call at 435-723-3370. We'd be happy to talk to you. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investment advisory services offered through AlphaStar Capital Management, LLC, an SEC registered investment advisor. AlphaStar Capital Management, LLC, and SLN Financial, Inc. are independent entities. Insurance products and services are offered through individually licensed and appointed agents in various jurisdictions. SLN Financial, Inc. does not offer legal or tax advice.